Hello, this is Dave, and welcome to Equity Story. Um, just before I start today, this is just general share advice and not personal, as per the disclaimer you can read here on the website. It's actually it's going to be a little interesting day. It's quite a lot to talk about, and I think the first thing is the RBA again lifting interest rates yesterday. There's a lot of talk around town at the moment about our inflation and sort of a lot of the effects when you lift these interest rates, they tend to lag a little bit, and possibly I think the RBA, there's talk they need to slow it down a little bit in the coming months. Um, Unfortunately, and nobody really knows the answer. And I'll tell you what, who definitely doesn't know the answer is is the RBA, who a year ago were telling us they wouldn't be lifting interest rates to 2024. At the moment, I think the appalling thing is we got someone in charge of our monetary policy that should be there. He's failed us dismally. He got the whole thing completely wrong. And I think he's got the whole thing completely wrong again. And I think he's totally misjudging. Um, well, in all fairness to him, he hasn't sort of come out exactly and said he's going to have to keep raising interest rates up and up and up. But definitely, I think the market who thinks there might be a pause, the market's definitely got it wrong. Interest rates need to go a lot higher. And I think we could have a look a little bit at inflation, and maybe I've got some nice little charts here, which I sort of borrowed off a very good guy on the internet, shall I say, and just look at the sort of areas that cause inflation. And there's a number of areas here. Obviously, you've got wage growth, and it was interesting today seeing NAB putting up uh, um, salaries by what 5%. You've got rising input prices. Oil going up. You've seen oil going through the roof. Transport costs go higher. Gas prices are high. Because gas prices are higher, fertilizers are more expensive. Food goes up. There doesn't seem any slowing down for me in that sector at all. You've got currency. You've got the US dollar getting stronger and stronger. That you've got that pass-through inflation. At the moment, we've got record low unemployment. You've got wage push inflation. You've got a rapid expansion of money credit. This is, the ridiculous policies I think not only in Australia, governments have had around the world of stimulating the economy by expanding the money supply, which again causes this demand pull inflation. There is inflation coming from every which way, everywhere you look at the moment. And that is a serious issue. And I think when you look at that, there's a high chance things are going to get a lot tougher. And it is possibly, we're talking about our markets, and we're talking about a much bigger, major correction in September, October. And the question is when will the market really say, I get it. This inflation is just so much worse. And it's ridiculous to think. Ridiculous. If we've got inflation at 6-7%. In America, it's most probably, if you go by the old statistics, it's around 12, 13, 14%. In the UK, it's 13%. Europe, it's going through the roof. It is ridiculous to think, absolutely ridiculous, that you can lift interest rates up to 3, 4, 5% if the inflation's that high, it's going to slow it down. Even now, where our interest rates are historically, that's a very stimulatory interest rate to stimulate the economy. I fear for our housing market. I fear for, obviously, and I think the RBA have got a lot to answer for putting people in home loans at ridiculously obviously cheap mortgage rates, and encourage people to borrow excessively. It's absolutely, I think it's also been a policy we've had now in Australia really for the last 15, 20 years. I think our interest rates have always been slightly lower than really they should have been. I think, again, we've seen that a little bit around the world, this idea that we're scared to have a recession. We're scared to have that natural clean out that historically we did have every 10 years, which is healthy capitalism. Um, Whenever you get government, and it's incredible, it doesn't matter where it is around the world, and government get more entwined with the economy, the more problems you get. You're talking about the student loan problem in America. I was listening to a really great economist talking about that, and he said in the old days there wasn't such a problem with student loans. There used to be a saying, "Hey, guess what? I worked my way through college. I was a waiter." You know what? You can't work your way through college now because unfortunately the costs of going to college and university in America is just so expensive. Why has it become so expensive? Because the government's got involved and the government started um, putting money up and helping people go to university. And what did that do? It meant the universities and colleges just lifted their prices. Government can be so destructive if you get over government. And I understand you need government, but it can also cause a lot of problems. And I think certainly the sort of policies that we've seen around the world of ever since really 2007, 2008, of having to stimulate the economy and stimulate it. We can't do that anymore. And we've got a problem. We can't, our interest rates aren't particularly high that we can lower our interest rates to stimulate our economy. They're just not there. We're in a period of high inflation, and high inflation is, generally speaking, a real problem for asset prices around the world, especially property, but also a big problem for the share market. So that being said, our job is to just give you the facts, tell you the truth. What it does do, it gives opportunities, because when you get euphoria in the markets and stocks run to ridiculous prices, you also get the opposite. Stocks will overcorrect and go ridiculously low. And there is going to be the opportunities for possibly members of Equity Story to really take advantage of this market and really make those fantastic long-term investments where they can get stocks at excellent prices. Someone was saying, the S&P 500, and I think this really struck me. Sometimes, people are talking about the markets, and this analyst in America, he said, if this right now is the low for the S&P 500, it'll be the most expensive low the S&P 500 has ever had. So just put that in a little bit perspective. So, we're of the opinion here at Equity Story, these markets could correct. Certainly in America, 20, 30, 40%. And even here in our market could go down a lot lower as well, and maybe come back down here to another sort of 20, maybe 20%. It might not happen, but I think when you're investing and you're investing in shares, you need to look at the worst case scenario. Sure, if the momentum changes, we can have a look at that, and hopefully the charts will guide us, because at the end of the day, the charts never lie. So, Dave, if you're saying it's going to be really, really tough, why we invested at all? That was the question I had on Ask the Analyst. And I think, good question. And why would you be invested? And I think most sensible people now have most probably got 60, 70% in cash on the side. I totally get it. Wait for, when the market goes down, what do they say? It's up the staircase and down the escalator. So it does go, when it does tend to fall, it tends to fall fairly quickly. It might take 2 months, 3 months. It could take 6 months, but you're not going to swim against the tide. But as that market falls, we're going to get some opportunities. I find it really insulting sometimes that people say, "Oh, I'm a long-term investor," and you can actually have a look at the Dow, and you can say, "Okay, over 100 years, long-term investor, of course you're going to do all right." Actually, do you know there's some fact that people don't talk about? If you took your money out before these crashes, your returns would be in the hundreds and 100% higher than it would be if you just held a story for 25 years. So you do need to be smart, and you do need to get out of the market if it's going to fall. And at the moment, it does look that way. At the moment, it does look like potentially it could absolutely collapse. There's maybe just one thing that could stop the stock market collapse, maybe one thing, and that is a likely scenario, is a bigger war in Europe. If we had a bigger war in Europe, I think you could see millions of dollars possibly come to countries like Australia to invest in sort of more stable country that's maybe a little bit protected from the war zone. I think a lot of money, cash, would obviously go into the United States of America. So, and that could possibly artificially just support prices. But at the moment, the way we're seeing it, I think the world is very, very tough. And I'm just going to reiterate it. That person has said to me, why are we in it? Very good. And like I said, I think some really good traders at the moment of 50, 60% on cash on the side, just waiting for those opportunities. What are certainly sort of, I think, more longer term investments that you can argue that you maybe hold is stocks that are giving a dividend, and the stocks that are giving a dividend that maybe can hold it through this crisis. So, if you put your cash in the bank, what are you getting now? Sort of 2-3%. If you get 5, 6, 7% dividend, and you feel the company's going to be able to keep giving you that dividend over a difficult period, well, it's most probably it would be a hold. With a period of high inflation, I suppose it's interesting, and again, I stole this off another guy on the internet, so apologies for stealing info like this, but I'm sure he got it from somewhere else. This is quite interesting. This is a graph of how basically businesses or companies do in periods of high inflation. And there's some interesting sort of ideas that we need to look at here. And the first one, what does really well historically in periods of high inflation is actually gold. So gold does reasonably well, and you can see here it's at the top of the list. The next one is agriculture, which is again second on the list. Oil, petroleum, and again you can see, not at the moment, certainly not gold. Gold hasn't been doing well, but you can see agriculture and oil's held up. So have insurance, which is number 4 on the list. And funny enough, beer and liquor. You'd think beer and liquor would be maybe something that would be more of a luxury, and in times when times get really difficult, maybe people would drink less, but that's actually not what history shows us. The more tough times get, the more we drink, and I'm certainly guilty of that one as well. And again, actually, you can see coal holding up reasonably well. What you look for down here is the products which are discretion, or ones that we need to have fun or enjoyment. This is the at the moment you can see aeroplanes, less people flying, so maybe they're building less aircraft. That wouldn't be very good for a company like Boeing at the moment. Computers, automobiles, toys, guns, steel production, maybe that's a little bit different now with China still needing to produce a lot of steel, I think, to keep everyone at work. But generally speaking, that sort of chart gives you a pretty good idea. But it's these businesses up here I want to have a look at, and I've got some on our market that we could actually have a look at and see how they're trading. And what I do, I've sort of had a look at some earlier to prepare. And in the gold sector, our preferred gold play has been Newcrest. And I've got a brilliant analyst. We've got brilliant ones, obviously, with Claude, who you saw last night and Ask the Analyst Live. But I've got the Wolf, who I think one of the best resource analysts in the country. He's looked at a lot of gold plays for us, and certainly Newcrest, with their cost of production, looks like certainly the best one. Gold is interesting at the moment, and I'm not saying you buy it now, but maybe if gold turned, you could buy Newcrest and you could look to pick a bottom. It's not what we'd like to do at Equity Story, but when you look at the historical facts that gold does do well in periods of high inflation, one would question why we haven't had that move yet in gold, and could we potentially have it? And it's interesting, these gold plays, you know, you can look at Evolution and Northern Star and Newcrest, these great gold plays that they are down at the moment, pretty strongly. So, you know, are we going to pick up on them? No, we're not. But I'll tell you what, if this starts to pivot and we can look at maybe trying to buy the reversal, definitely we'll have a look at it. And I'm going to bring you the gold chart across so you can just see a little bit how possibly we could reverse from this level. We are right now here on the weekly on long-term support, exactly where we've hit it before. Now, we need to hold that level, as I do fear if we don't hold that level, you could see even Newcrest go down a little bit lower. So I'm watching this quite carefully because you know what? We're gonna, you know, when you buy something like Newcrest, we know it's a good company. It's the production costs, I think, are about 1,200 an ounce. We'll take that any day. There's good money in those numbers. But if we can see gold just start to pivot, start to turn up, you know what? I think we're going to have to buy some, definitely in this inflationary environment, we're going to have to buy some gold. So I'm watching it closely, guys. And as soon as I see it, we're going to have it on TradeWatch. We're going to have a look at something like a Newcrest. And again, MEK, you know, it's down a little bit more, just a better opportunity to get in it. This is gold. It's in the right space. It's also got the explorer development upside to it. It doesn't look expensive on these numbers. Those gold hits were fantastic. A little bit of weakness, absolutely love it. You know, next on that list of stocks to hold in inflationary times was agricultural stocks. And when you look at those, I don't think there's any better in Australia maybe than Elders. Good company. You know, it's not really trending, but I can sort of maybe argue put this one on a monthly, and we can have a look how it's doing on a monthly. And it's actually holding sort of monthly levels reasonably well. So certainly Aldous possibly is one you could put on your list. And the other one definitely I think is GNC. Now we did speak about this with Claude the other day. He's not that keen on it. You know, he's looking for, you know, sort of companies where they've got much better growth potential. But I'm just talking about a story that if you can get a dividend, I don't think the dividend's too bad in GNC, but certainly in a pullback, if we get a little bit of a shock and a pullback, I think if you take a medium-term approach and you can get 5% or maybe 5.5% dividend on something like Grain Corp, I think it's well worth having a look at. I'm just going to go back to the weekly chart. Then there's two other stories. Third on that list of companies to earn in times of high inflation were oil companies and gas. And you've got Santos, which is actually holding up very well. And I tell you what, I wouldn't mind getting into that at all. And certainly Woodside. What's interesting, I was reading a report in America and how the Americans and Biden is really digging into his U.S. reserves to the point that you know, I think it's going to hold the price of certainly we could dip a little bit, you know, as maybe this next 2 months with oil price could dip. But I think if you take a medium term approach, we're going higher. And this is because I think Biden's really failed policies. And I'm the most, you know, me and Wolf, you know, we love the renewables. We're really green, but he's just doing it too hard and too fast. And his policies, and he's made a real sort of, this is what I'm doing. I'm not changing my mind. And as a result of that, you know, the USA under Trump was really an exporter of oil and gas. They were, but Biden's slowed it down to the point that there's massive shortfalls, and I think there will be as long as he's in power. And I wouldn't be surprised if we just see, if you take a medium, yes, in the short term we could dip, but in the longer term we're going to see higher oil and gas prices. If that's the case, you know, things like Woodside, I think you'd be holding these for a long term. And this might, and the Santos, and you know, these are stocks I'm saying that just might be in that sort of 20-30% of the type of stocks that you might hold through this environment. Because at the end of the day, you're always trying to hedge your bets, aren't you? Mostly cash, but I'm going to hold a little bit because guess I could be wrong. The fourth on the list was the insurance companies. And there's a few that we've actually spoken about in Equity Story in that we like, and I'm just going to mention a few of these now, and the charts are holding up really well. NHF, which looks very good, which is obviously health insurance, PSI, AUB, and Sun. And it's interesting, Sun actually paying a reasonably good dividend. So again, one of our preferred dividend payers. But it's interesting that you can see these sort of sectors that I've talked about of companies that tend to hold up really well in high times of inflation are actually still holding up reasonably nicely in our market. And I think the last one on the list is beer and wine, and maybe Treasury Wines is possibly the best one on that list. And again, you know, isn't it funny that these sectors, these gold, well, certainly not gold, but agriculture, oil, insurance, and beer and wine, these sectors are holding up really well in this high inflationary environment. The only one that's not is gold. And that's why we could, guys, have an opportunity here, but we just need to see gold start to pivot. And you know what? I think we need to get some gold. On that note, interesting times, and you know, like we're obviously we're going to try and talk you through it, but there were some announcements today, and Metcash came out with, I thought, a very strong announcement where they've actually said that over the last sort of 17 weeks, around July, August, that their sales are improving and a little bit higher. They did come out and say, I'll give you exact numbers. Actually, I'll try and bring it over so we can have a look. Here we go. Basically, they've got group sales increased 8.9%, which is excellent. And they're talking a little bit that maybe the cost of petrol, instead of maybe driving to the Coles or the Woolworths, which is maybe some places might be 5 miles away. People are saying, well, I've got IGA, I can just walk to it. It's nearby. I don't have the petrol cost. So they're finding this localized shopping and possibly high petrol prices is helping them from that point of view. But generally speaking, they're doing reasonably well. But what they have said, and again, this is what we're talking about inflation, we're experiencing and managing increased supply chain and labor cost pressures. I think this is an issue, obviously, across the board at the moment. But generally speaking, I think they're handling what is a difficult situation reasonably well. And although sort of food companies are not right on the top of the list of companies to buy in high periods of inflation, they're certainly towards the top half of that list. And when you look right now at Metcash, it's giving around a 5% dividend. And I think in this environment, that's looking a little bit juicy. So for me, if you're looking for a dividend stock and you haven't got Metcash, I think it's well worth having a look. Just be wary. Again, I saw TMS, and I've got the Great Wolf, who teaches me a lot about these resource stocks, and they come up, don't they? With I'll just have a look. Let's bring this over a little bit. We can have a look at it. We come out here with really exciting. Latest hold includes massive sulfides grading up to 54.5%. When you look through it, it's only 0.8 meters. That's quite some good meters there, 40 at 2.6. Again, you look, it's not too deep at 131. Okay, but it's early days, and what I wouldn't be buying these sort of companies at the moment. And you can look at, I think, our benchmark EM2, which is, I think, a really great little copper explorer, and it's come up with fantastic grades for the last 6-7 months. But at the end of the day, the market's just at the moment just doesn't seem too interested in these stories at all. Now, without trying to be a little bit doomy and gloomy, I'm going to give you some stories where the market has had some fantastic, so the brokers have given some really strong target prices on. And I think we talked about NHC, and we've spoken about Whitehaven Coal. Now, I'm just going to give you some analyst reports on these to give you some idea, maybe how bullish some people are. So just bear with me, because on my own today, so I'm having to do 2 screens and trying to look at everything at the same time. But at the end of the day, we want to buy things that are going up, and we can see things like NHC and Whitehaven are going up, and they're looking pretty good. And what we did today, we had Credit Suisse, who came out with an outperform on, let's go to NHC first, on NHC. And their target price is just here, under $8, $7.90. And they're talking about the thermal coal price increases. Very, very exciting. And they're saying here, Credit Suisse is estimating a 21% dividend yield in September, lifting to 33% and 28% in FY23 and 24. The broker expects net cash to grow to 2.7 billion by the end of FY27, leaving room for further returns. So extremely bullish at that target price. And if you're in these sort of stories, yes, I think you've got to have a tight stop. They've had a bit of a move, but sort of maybe sort of don't put that stop too tight. I think last night I was talking about Whitehaven Coal, you know, or if you do have it tight, then just get back in if you get that opportunity. Let's have a look at Whitehaven as well. Again, I think Whitehaven had an incredible target price. So again, bear with me and I'll give you that target price, what it was. And I'll give you the sort of spiel around why they like the target, why they like the story. So Whitehaven Coal, again, they've got a target price of 11.20, which again is a 20, what's that, around sort of 20-30% upside. The company as well is giving a very, very attractive dividend yield at the moment at these sort of prices. So some of these coal stories, you know, if I have a dip, I'd be getting into them. If you're going to put a stop loss on it, yeah, I mean, it has had a run, but you know, don't make that stop loss maybe too tight. And if you have any problems with the stop loss, let's just keep revisiting it. On RCNS Live, we can keep working out, and hopefully together we'll just see how the stock's moving and see where we can get there on that that dividend price. You know, where you've got to be a little bit careful. Suddenly, you often find when governments, and you saw what happened in Queensland with coal doing really well, and the Queensland state then lifted their taxes on these coal producers. You just don't know. It could happen as well in New South Wales. I mean, governments, when they see companies making squillions of money, well, you know, it can happen anytime. So just be a little bit careful of that as well. And the other one, absolutely huge, was little SWM. And again, God bless the wolf. He does give us good stories, and he absolutely, this is one of his favorite sort of players in the medium, sort of the media space. The only thing I would say, you know, if you look at stocks in inflationary times, this is one of the ones you can argue might not be brilliant. Some people argue, well, it's free to air, so maybe, you know, people will not have Netflix. Maybe they won't have these channels they got to buy or pay for, and maybe that could be good for SWM. But Credit Suisse were really bullish on their AFL deal, which sees them through to 2031. And again, they've reiterated their target price of $90. So nearly, what's that? That's nearly an 84% increase from here. We know the stock isn't expensive. It's trading at very low multiples, about 4.5. And possibly from a valuation point of view, you could see that happening. So certainly one to have on your watch list. And certainly if you're holding it long term, I fully understand why you'd be holding it. If you're a trader, you are going to be out. If you're a trader, you're certainly going to be looking at this one if it pops back over that 52 cents. On that note, that's all I've got to talk about. Hopefully, we've given you some great ideas like Metcash, a dividend play. You know, New Hope, Whitehaven, the coal play is still looking good. SWM looks absolutely superb, and you know, the stocks on high inflation, the ones that you could be looking at. And I think really importantly, possibly, we've got an opportunity with gold sometime in the next 2 weeks. So hopefully, if there's money to be made somewhere in this market, we can find it for you here at Equity Story. On that note, I'd like to thank you for listening to us and listening to me, and hopefully that advice is you're going to take it to heart and make some money with it. Thank you. Bye-bye.